I shall start now, and thank you to everyone for your patience, just bearing with us whilst participants join the event, and welcome to everyone who's been able to join us live today to talk about the rule of law and foreign investment. A recording will be available on the Red Lion Chamber's website, so please do share the link amongst your networks and with your colleagues who you think might benefit and enjoy our discussion, but who are unable to join us today. I'm delighted to be here today with not only a distinguished panel, but with Mark Guthrie, who is a fellow consultant member of Red Lion Consultancy, an organisation established by Dame Linda Dobbs a couple of years ago. Mark is a barrister with international legal and governance expertise, with connections across judiciaries, governments, NGOs and intergovernmental organisations, and he has an in-depth understanding of the judicial and political systems across Europe and Commonwealth regions. And he'll be speaking at the end of our discussion today about Red Lion Consultancy. My name is Sara, Carnegie, and I'm delighted to be chairing this meeting today with this fantastic group of phenomenal speakers. Before I just introduce each of them, I would ask that if you could please put in any questions that you have into the Q&A box. This will be monitored, and there will be 10 to 15 minutes at the end of the session where we will try and go through as many of those as we can. Anything else that you may wish to say within reason about yourselves, where you're from, please pop that into the chat box. So if you could use those two functions accordingly, that would be great. So I now come to our wonderful guests, and if I may, I'll start with John Sherman. John is a business and human rights expert and legal advisor. And from 2008 to 2011, John was part of the central team advising the special representative of the UN Secretary General for Business and Human Rights, Professor John Ruggie, who is author of the UN Guiding Principles on Business and Human Rights, but who very sadly passed away in September of this year. John, since that point, has been General Counsel and Senior Advisor to Shift, which is an independent not-for-profit which is the leading global centre of expertise on the UN Guiding Principles. He's worked with Fortune 500 companies, with major international law firms and bar associations to help them to align their policies, processes and practices with the UN Guiding Principles. So he's an international recognised thought leader on this subject. Speaking in his personal capacity here today, as are all of our speakers, but we're delighted to have him with us. Professor Andrew MacLeod is a visiting professor at King's College London, an author, businessman, former aid worker with the International Committee of the Red Cross, having been based in former Yugoslavia and Rwanda, and is an accomplished organisational leader in the not-profit and not-for-profit sectors. He's run major national disaster operations for the United Nations, notably in Pakistan in the aftermath of the earthquake from 2005. He's led membership organizations. He's been critical in startup to growth, sustainable investing fintech companies, is a public policy expert focusing on areas including China's Belt and Road Initiative, and has appeared on major global TV networks. Dominic Parker is the managing director of Fitzrovian Africa. Now, Fitzrovian Africa is a company that helps businesses, investors and government agencies navigate their way into, across and out of Africa. He's formerly one of the youngest ever directors on a global board at PwC, and has worked across Africa on market entry, service development, capital raising and problem resolution projects, advising blue chip companies, financial institutions and high net worth individuals. So a really accomplished and great speaker on this area. Faisal Siddiqui is the Deputy Chief Compliance Officer at the International Finance Corporation, which is the private sector arm of the World Bank Group. In this role, he helps lead their business risk and compliance department, which focuses on integrity, regulatory, international tax and other risks. He also manages their integrity due diligence efforts, including anti-corruption, anti-money laundering and sanctions, and heads many of its crisis management teams. Most recently, he co-led the IFC response to the fall of the Abaraj Group, described by The Economist as the biggest collapse in private equity history. Prior to this, Faisal was managing director at Fannie Mae, responsible for all compliance investigations for the institution, and has done a number of other things with banking industry, worked as an assistant staff judge advocate in the Judge Advocate General Corps of the United States Air Force. Thank you for being with us, Faisal. Finally, but last but not least, is David Ziyambi, who is a partner and member of the Latham and Watkins Finance Department of their Africa practice. His practice focuses primarily on project structured and leveraged financing in the energy and infrastructure sectors, both within mature and developing markets throughout Africa. I noted that he was part of the team which advised on the $20 billion financing for Mozambique's first ever onshore liquefied natural gas development, notable for its sheer scale and complexity, and has done numerous other incredibly complex and impressive projects in recent years. He represents sponsors, lenders, and governments on a range of matters, from project development and project finance deals to structured financing, prepayments, and reserve-based lending. So, to my audience, after that whistle-stop explanation of the qualifications of our panel, I'd say that you're exceptionally lucky to be hearing from this incredibly experienced group of individuals. I'd like to start with John, if I may, because you set the scene for us, given your basis, your background. And I'd like if you could tell us in a couple of moments about the UN Guiding Principles on Business and Human Rights and why they are important for foreign investors. John, over to you. I think you're on mute.
Okay. Thank you very much, Sarah, and I'm delighted to be here and hope to learn from my other panelists and the questions from the audience. But just to briefly sketch the guiding principles and why they're important for foreign investors, it's really necessary to understand them in order to meet soft and hard law standards with respect to internationally recognized human rights in their operations and in their value chains. That responsibility is articulated in the 2011 UN Guiding Principles on Business and Human Rights, authored by the late Professor John Ruggie, which the UN Human Rights Council unanimously endorsed following 6 years of research, dozens of multi-stakeholder initiatives, and lots of pilot projects. And they are recognized as the global authoritative blueprint for the steps that states and businesses should take in order to uphold internationally recognized human rights. In fact, 10 years have passed since their endorsement by the UN Human Rights Council. The guiding principles have experienced deep and wide uptake. They're reflected or incorporated in public, commercial, and private law, in regulations, in multi-stakeholder normative standards such as the OECD guidelines for multinational enterprises, in the decisions of investors and lenders, in the policies and practices of leading companies, in judicial and quasi-judicial decision-making, and in the advocacy of civil society. Now, while they're soft law, the guiding principles, they're increasingly codified in hard law as seen by the appearance of mandatory human rights due diligence legislation in France, in the Netherlands, in Germany, and the current EU initiative to adopt EU-wide mandatory human rights and environmental due diligence throughout the EU, which is the world's largest trading bloc. And much of that legislation has extraterritorial impact on companies who are located outside the EU, but nevertheless do business with them or in them, and have value chains throughout the world, which are all subject to the need to respect human rights. So, what are the UN Guiding Principles? They consist of 31 principles and integrated commentary, which are based on 3 interdependent pillars. The first is the state duty to protect human rights from business-related human rights abuse. That's a legal duty imposed by treaties and international instruments, which is carried out by adjudication, investigation, judicial decision-making, etc. The second pillar, which is really what we're going to focus on, is the business responsibility to respect human rights, which means not to infringe them in a company's operations and in its value chain, its supply chain, etc., through the exercise of a process known as human rights due diligence. And the third pillar is the need for greater access to remedy by victims of business-related human rights abuse. That is a primary responsibility of states, but businesses do play a role. Now, I've talked about human rights due diligence. Let me outline that and I'll stop. Human rights due diligence, as I said, is a key pillar of the guiding principles. Pillar two, the responsibility to respect human rights. And as I mentioned, several EU states are translating it into legislation. Human rights due diligence is a stakeholder-centered risk management process that enables businesses to know and to show that they are respecting human rights. And it expects that through engagement with stakeholders, companies will identify the risks of involvement in human rights impacts throughout their business, throughout their operations and their value chain, which requires extensive mapping, to respond appropriately to involvement in human rights risks and to track and report on their human rights involvement. Where companies contribute, cause, or contribute through their involvement to human rights harm, they're expected to stop their conduct that causes harm, to play an appropriate role in the remedy of harm that they caused or contributed to, and to exercise leverage in an attempt to influence third parties who caused the harm directly and get them to stop it. Human rights due diligence is different from transactional business or legal due diligence because it's ongoing. It's not a one-stop process. And because it is based on engagement with stakeholders and is focused on seeing risks to people from their perspective rather than a harm to the company's commercial interests. However, as I can point out later, severe harm to people and severe harm to businesses will likely converge in the mid to long term. So I'll stop here and get back to some of those issues later.
Thank you, John. Yes, I think it's important that we do come back to that point, but I'd like to now turn to Andrew to get some colour on those issues that John has raised, and perhaps to draw on your time that you spent in Rwanda, Andrew, and perhaps lessons that came from that experience, which show how perhaps one can best set an enabling environment for capital flow into the economy.
I think that's exactly right, Sarah, because whether we're talking about human rights or development, at the end of the day, we need to grow economies so people can get employed. The one meaningful indicator about breaking the cycle of poverty is to someone have a well-regulated and well-remunerated job. At the end of the day, health, education support, water support, they're all process indicators to get an outcome. But to get employment in an economy, you need investment to come into that economy. And what we saw in Rwanda post-genocide in the late 1990s was a really interesting experiment that a country took. Rather than going the aid-based way to development, they went the trade-based way to development. And the four key lessons that came out of Rwanda were, firstly, you need transparency in the exchange rate mechanism so people can understand what their money is going to be worth. Secondly, you need the ability to repatriate profits if profits are made. There's no point making a profit in a country if you can't get it out. You're not going to invest in a country if you can't get a return on your capital. Thirdly is zero tolerance for corruption. Rwanda is still ranked higher than about 3 or 4 members of the European Union on Transparency International's index on corruption. And there's this perception of Africa as in poverty, in war, a very dangerous place, a very corrupt place. Many of these views are in fact 15 to 20 years out of date. The Fourth thing that Rwanda learned is you need to have enforceability of contracts under local laws. And this is where the rule of law really comes in. It's very difficult to invest in an economy or a legal area if you think you're going to be gazumped by corrupt plutocrats. So the four key lessons that come out of Rwanda: 1, transparency in the exchange rate mechanism; 2, the ability to repatriate profits; 3, zero tolerance for corruption; and 4, the enforceability of contracts under local laws, the rule of law. And what that then does, Sarah, is it creates the enabling environment which lowers the perceived risk of a potential investment country. And with a lower perceived risk, you need a lower perceived return to invest in that country. So if you lower risk, more capital flows. And that's where we get really interesting. And I'll finish off on this set of statistics. Pre-COVID, when you looked at capital flows from OECD to non-OECD economies, from the developed world to the developing world, roughly 53% of capital flow went through the private sector. About 30% of capital flows went through remittances, and only 17% went through aid and philanthropy. And if you ask most people on the street, who's better at bringing the world out of poverty, the aid sector or the private sector, most people would say the aid sector. But capital flows actually say the other thing. And what we've got to do post-COVID is start to look at how do we unify those three great capital flows: 53% through the private sector, 30% through remittances, 17% through aid and philanthropy, and getting them working together. And the critical element of them working together is creating the enabling environment for investment that comes through the rule of law.
That's great. I think this brings us, nicely on to Faisal, if I may, because one of the, questions that I've always had is how do you overcome the perception of risk in order to make investment and help bring a country into a slight better position, I suppose. I mean, it's a very sort of layman's perception of it. But I'm interested to hear about the role of the World Bank, and in particular your arm of it, the IFC, and the considerations that you take on board when making investment decisions, particularly in fragile states.
Sure. Thank you, Sarah. So the IFC, the International Finance Corporation, is what we say the private sector arm of the World Bank Group. And what that means is we try to do is exactly what Andrew was talking about, is bringing private capital and addressing poverty from the perspective of the private sector. So we are part of the World Bank Group. And when you hear the term World Bank, most people think about the International Bank for Reconstruction and Development, which does loans to governments who then use those loans and proceeds for example, infrastructure projects. What we do is we invest directly in the private sector. So we're more like a investment bank that is a development institution. So we do project finance loans, corporate loans. We invest equity in companies directly. We invest in private equity funds. And all working directly with the private sector. We've been doing this since 1956, since we've been established, and very much in tune with the current environment of impact investing. It's actually written in our charter that we both have a development mission, but we're also here to be profitable and to be self-sustaining in that aspect. So when we look to invest, it's not just on a concessional basis. We look to invest, but also overall to make profit in the areas we invest. One of the most significant things about what's been going on at IFC in the last couple of years is a change in our strategy, specifically towards what we call fragile and conflict states. And we've pledged that by 2030, 40% of our book of business is going to be in these countries under that designation. And those countries span the globe: Haiti, Kosovo, Burkina Faso, Papua New Guinea. There are a number of countries that meet that criteria. So 40% is quite a bit. Last year, we did 32 billion worth of projects business. So how do we address that? To your question, how do we address? So my job, even though I'm here speaking on a personal capacity, but the job of our compliance department at IFC is to try to address some of what you would call the compliance risks: corruption, fraud, politically exposed persons, issues that can cause reputational but also financial damage to IFC. And sort of generally speaking, our philosophy on that is a bit twofold. One is the best defense is a good offense. So we spend quite a bit of time on the front end doing what we call integrity due diligence, kicking the tires, if you will, around the deal. Looking at issues of corruption, looking at talking to folks in the market. We've got over 100 offices in 95 countries. So we do a lot of due diligence around our projects, around our investee companies, around the individuals, the management, the shareholders, the beneficial owners, to ensure that these are entities that we want to do business with, and that the projects themselves don't have concerns related to all the compliance areas that we cover.
So the projects themselves, presumably, then it's an advantage if they are doing good for the community. There's obviously that broader sense of what's the impact going to be. That's
Sure.
Part of the consideration, which brings us to ESG, which we can talk about in due course in more detail. But that's currently very much the order of the day for business and investment.
That's right. I mean, we feel that we bring a lot of additionality. Why would someone come to the IFC when they can go elsewhere to another private sector bank and get the funds? And I think there's a lot of answers to that question, but specifically in terms of what you're talking about, the additionality of the sort of the advice and the due diligence that we do around a deal, around a project, to ensure that it's free of these type of risks, or if there are those type of risks, that we've mitigated them to the extent possible where we are willing to accept the risk. And I'd also mention that we crowd in a lot of investors. In fact, that's one of our mission, is to mobilize money. So we work with large investors like AXA, Swiss Re, Allianz, that participate in our projects, and as well as development finance institutes, sovereign wealth funds. So we're there to mobilize funds for our emerging sector clients.
Thank you, Faisal. I'll come back to you again in a minute, perhaps to hear a little bit more about some specifics, if you can give them on that. But I'd like to, if I may, turn to Dominic now and ask a little bit about your role in this. And when operating in emerging economies, which investors may see as coming with risks, obviously, such as compliance with US acts or the UK Anti-Bribery Act, for example, how can we make investment in those jurisdictions attractive to business with that additional bureaucracy and risk concern?
Thanks, Sarah. I think what you're asking is a really very interesting question. And indeed, it builds upon what Andrew has said with his example about Rwanda, about an enabling governmental environment, and indeed what Faisal has been saying about the integrity diligence that needs to be undertaken in businesses and organizations and projects that are seeking investment, and particularly foreign direct investment, which can often be regarded as cheaper than finding it locally. The biggest issue that we see with companies, and we work primarily in Africa, is that they hear about the necessary governance, compliance, and integrity orders and protocols they need to have in place, but they can often be regarded as a luxury that developed markets can have, whereas they are in often difficult situations trying to build a business. And so from our perspective, the best way of looking at this is to give people the chance to see the other benefits that putting in place good controls and protocols can have. Now, there's an organization that people on listening to this may be able or may have heard of, which is called Ethisphere. Ethisphere has been around for donkey's years, and it tracks how good companies are at acting with integrity. And in 2020, they have one of their many world's most ethical organization surveys, and it showed that companies that were ethical outperformed the US large cap index by about 13.5% over the previous 5-year period. That is a significant amount. But the question is, how did that come about? And this is, as I mentioned before, about positioning good governance as something that is not a bureaucratic nightmare, but something that brings genuine value to the business. Now, EY, I'm sure everybody here is aware of EY, the Big Four firm. They produce every couple of years something called the Global Integrity Report, an excellent piece of research. The previous one in 2020 had somewhere around 3,000 C-suite executives responding to it from around the world, in excess of half of which were from emerging markets. And they asked, as part of this survey, what are the benefits that governance and compliance, good governance protocols, brings to your business? And forgive me here, I'm going to run through a series of numbers, but I'll keep it short. 50% of respondents stated that good governance helped them build a strong brand reputation, which comes back to what Faisal was speaking about before, the importance of a strong reputation. 41% stated that good governance attracted new customers or new clients. 37% stated that it helped them retain customers and clients. 35% said it had improved financial performance. 31% said it had attracted talented employees. And we all know how expensive retaining employees can be. And finally, 31% said that good governance had minimized the risk of legal actions and enforcement actions. Now, what's interesting there is most people look, when they're investors, at investing in a business and governance protocols to prevent enforcement actions. But if we go through that list that I've just read through to you, that was the last on the list of benefits that it brought those organizations. All the other things, building a strong reputation, attracting customers, attracting staff, retaining customers, retaining staff, all of those are what bring together the ability for companies, as mentioned in the Ethisphere statistic, to outperform other companies. And for me, this is really the reason to position this with emerging market companies as not a hurdle, not a tiresome problem that we need to do in order to get investment, but as something that will encourage investors from overseas, because they need to see this so they don't fall foul of the US Foreign Corrupt Practices Act or UK Bribery Act, but also something that will help bolster and build the financial performance of their business. And this isn't easy, Sarah, I'll be honest about it. It's difficult to do this, but interesting. There was a website that has been published recently people may want to have a look at, called Ethics First. You can Google Ethics First. It's a platform that at the moment African businesses can sign up to, and it walks you through ethical protocols to put in place to show good governance. There are different tiers that you can go through here, and then you are promoted on that for foreign investors to see that you are acting with integrity, with good governance. And that, I hope, is a step forward that can be replicated elsewhere to help build that into place.
So that's currently for businesses in Africa alone, is that at the moment? Right, but has that been in place for some time now, or is
I said it's fairly recent. I came across it about 2 months ago, but we've been looking through it, and it's as a starting point, it's a really good process to follow, particularly if they have no knowledge of what to do in the first instance.
Sounds interesting. I'll have a look at that. I've noticed, I was going to come on to David, but Andrew, if you wanted to say something off the back of what Dominic's mentioned, forgive me, David, I think if we can just follow on the point. Andrew, did you want to follow up on something specific?
The point that Dominic's made now is a very important one to understand. An ethical risk is a financial risk. And for those who don't believe me, I've got 2 letters for them, VW. When the diesel scandal hit, it was an ethical screw-up on behalf of Volkswagen senior executives and the board. The result, other than a few billion of fines here and there and some loss of consumer faith, was destruction of shareholder value by measuring the stock price dropping over 30%, and it never recovered. Because not only did it drop, the growth of the share price after the drop was on a lower trajectory than before the growth. So you could argue that the cost was growing over time. And this is the big jump that we've got to make in the day of ESG. It's not ethics is different from a financial measure. Ethics is a financial measure. In Australia, Rio Tinto blew up Juukan Gorge, which is a 40,000-year-old cave, the cost of which has been billions of dollars in lost reputation and slower land use negotiations with Indigenous populations all over the world. So what Dominic has just said is absolutely spot on. Rule of law, good governance, ethical protection preserves the value of shareholder equity. And we don't pigeonhole ethics as something nice. It is something essential about the preservation of value.
Yeah, very important point. David, I'm going to come to you now because I wanted to ask you a question about the need for the rule of law in developing countries. And a key reason for that is the importance of property rights and security for foreign investors. And noting the recent statement that from the African Coalition for Corporate Responsibility that said formal legal structures may directly conflict with local traditions regarding land. And this can lead to greater chance of uprising or rapid change in governments. And appreciate this is quite a big question, but how can you have any suggestions on how corporations manage that risk?
Sure. I think, look, ultimately, it comes down to something that everyone on the call so far has mentioned, and that's risk. And it's risk perception and it's risk reality. The two are not always the same. If you look at generally how corporations manage this, it's diligence. That you have to upfront, before you go into a particular transaction, do a series of different due diligence on different matters. When you're looking specifically at land rights, for example, your diligence will uncover a few key things. So one, you'll see if there's, for example, a bilateral investment treaty, which gives some level of treatment of protection at a country level. And that has the force of law in the relevant country and typically enshrines land and property rights. Also, if you look at the way that local lawyers will produce a diligence report, they will look at the particular land issues that you referred to. So looking at local land rights, looking at whether they're legal versus traditional land rights and how that plays together. Now the truth is that in most jurisdictions in Africa, this is not something that is unheard of. There are people doing deals in these jurisdictions all the time. And the understanding of the risk relating to these things is actually quite well formulated. The issue is being able to find that information, going to the right lawyers, the right advisors who will be able to frame that risk for you and let you understand that, yes, in some certain circumstances, looking at that parcel of land, you're not going to be able to get title to that. You as an international entity are not going to be able to own that, but perhaps it's only local entities that can own that, which will precipitate a discussion for you around partnerships, right? So there are ways and means around all of these risks. The most important thing is understanding the risks upfront. And then once you've understood them, thinking about whether or not you need to mitigate against those risks, or ultimately, if there's no point for you and you feel that you don't want to invest because of the risk. But ultimately, it is about diligence. It's about advice. It's about really understanding what you're dealing with. And that certainty, again, is wrapped up in rule of law questions, because rule of law establishes the certainty that will allow a framework that can be explained to you by a local lawyer, a foreign lawyer, and indeed, maybe an environmental and social consultant whose scope sometimes does creep into the very sort of issues that I think were just alluded to previously by Andrew, where you're looking at local land rights, traditional land rights. How does this actually affect your investment if you're potentially displacing, local communities? And so all of these things are wrapped into the same question, really, and that is analysis of risk, ability to manage risk, and then mitigating it if the need be.
Excellent. So analysis, management, and mitigation of risk, key issues. I think it nicely takes me back to you, John, and I think the point that we were looking at previously, or at least referencing, about that convergence of severe harm to business and harm to people, but also the issue around the costs of social conflict between companies and communities. And I don't know whether you can give me any specific examples of that, or any particular points that you'd like to make. I know you're interested in the bilateral investment treaty point as well. John, yeah. You need to, it's still on mute for some reason. The perennial issue with the Zoom call, I'm afraid.
Okay, sorry about that. Yeah, let me talk about social conflict, and then also which responds to some of the points that David was making, and then also talk about bilateral investment treaty arbitration. Yeah, social conflict is highly costly to mining companies, for example, who are investing investing all around the world for their projects in ways that they don't always fully appreciate, since the costs of social conflict are not usually aggregated across a company's operations. In his 2010 report to the UN Human Rights Council, Professor Ruggie cited a Goldman Sachs study of 190 projects operated by major international oil companies, which showed that the time for new projects to come on stream had nearly doubled in the previous decade. And an independent analysis of a subset of that revealed that non-technical risks accounted for nearly half of all of those delays, with stakeholder-related risks, including human rights risk, being the largest part of that. And one major one major international oil company estimated that it had experienced a $6.5 billion value erosion over a 2-year period from stakeholder risks. And further research has deepened the understanding of the costs of social conflict. According to a 2014 study, which involved field research in Peru, elsewhere in Latin America, the most frequent costs are lost productivity due to shutdowns and delays, together with lost sales. They noted that a major world-class mining project with a capex of $3 to $5 billion would suffer roughly $20 million a week, of delayed production in NPV terms. The greatest costs are the opportunity costs arising from the inability to pursue future projects, expansions, or sites. And for example, when the owners of the Conga project in Peru suspended operations in 2012 at the request of the Peruvian government following violent social conflict, the estimated life production of the deposit was 15 to 20 million ounces of gold and 4 to 6 billion pounds of copper. Finally, the most overlooked costs are the staff time needed to manage social conflict. In some cases, senior management had estimated that assets worth 10% of the company's income demanded more than 80% of senior management's time, and including the time of CEOs. So yeah, there is a convergence between the two. This was very important to Professor Ruggie during the mandate. He visited a mine in Cajamarca, Peru, which, when it tried to expand its operations, nearly 10,000 people blockaded the roads to the mines, causing the owners to shut it down. And they were protesting inadequate consultation and compensation for the resettlement of people who were displaced by the mine, lack of job opportunities for local people, inward migration of people looking for work, causing crime and overcrowding, dead fish in the lakes and streams that were used for fishing and drinking, and the poisoning of almost 1,000 people from a spill of 300 pounds of mercury from a company-operated truck. And the cause of this was the company had no means of engaging, no process of engaging with the local communities to find out what their concerns were from their perspective. In other words, it lacked human rights due diligence. So this is an example of where Professor Ruggie, right at the start of the mandate, saw the need for human rights due diligence to address and prevent social conflict which is harmful to people and harmful to companies.
Thank you, John. That's a powerful example. I think, Andrew, you've got your hand up. I was going to come to you next anyway, but I think you might have comments on that.
Yeah, at the same time, Professor Ruggie was in southern central Peru. I was in northern Peru around the La Granja mine project Rio Tinto was running, and they were taking a very different approach. And what Rio did with a particularly wonderful woman named Sharon Flynn, set up a whole series of rondas, which was the old traditional form of governance pre-colonialism, but interestingly set up female rondas as well as male rondas to properly consult with the community. And whilst all these other mining companies were having shutdown problems, Rio Tinto wasn't, because they'd put in place a series of projects called Human Rights Matters, which was co-written by Professor Ruggie and Vanessa Zimmerman. And Rio understood really well back then that the social cost is a financial cost, because what we've seen out of the business schools of the 80s and 90s, the greed is good, Gordon Gekko period, is a whole series of managers were trained to think the only thing that mattered is the balance sheet, and they forgot to monetize social risk. They forgot to monetize ethical risk. They forgot to monetize environmental risk. The great tragedy of Juukan Gorge in Australia, the caves that Rio Tinto blew up, is Rio Tinto had undone all the learning that it had previously learned from Bougainville in the 1980s, applied very, very well in the early to mid 2000s and 2010, and then forgot when a new CEO came in, who I happened to know when I was working for Rio. So it also shows that just because you've learned the good process once, doesn't mean you're going to learn it forever. And we've got two really interesting and exciting changes that are happening in the world today. One is the millennials are now starting to replace those managers that went through business school of the 80s and 90s. And the millennials tend to understand that social risk is a financial risk, and we're seeing these new applications. But the second and really exciting change is the growing amount of patient capital that sits within superannuation and pension funds around the world. In Australia alone, $3 trillion is sitting in pension funds. And that's investors that invest with a 10, 15, 20-year mindset, not a quarterly mindset. And what's important about that, if you're a trading shareholder, buying and selling on quarterly returns, the chance of you owning a stock on an ethical screw-up is pretty small. But if you're looking at holding a stock for 20, 30, 40 years, the chance of you holding the stock and getting the ethical screw up like the Volkswagen diesel scandal is almost certain. So you now see what was called activist shareholders, but are now really patient shareholders in pension funds and superannuation funds who are saying to boards and saying to senior executives, you've got to take this stuff seriously, not because it's nice, but because it's protecting the value of our assets. That's the real revolution we're having now.
Thanks. I think, John, you wanted to come in on some additional information about Peru's financial regulator.
Yeah, thanks, Andrew. I just wanted to just supplement what we both were talking about in Peru. Just to give some background, Peru has one of the lowest metrics of social trust in the world, and particularly between rural communities and companies and the government. And this, the problems that Professor Ruggie noted were addressed in, I think, 2014 by the Peruvian financial regulator, Professor Daniel Szydlowski, who got a regulation enacted that would recognize that social conflict was not only harmful to companies who were directly investing, but also to the Peruvian financial system as a whole, because the externalities from social conflict ended up on people's balance sheets within Peru. So he enacted a regulation, environmental and human rights risk management process to be that would be used basically by banks who were investing in high-risk situations to make sure that a person of trust was brought in to be able to help facilitate engagement. And this kind of environmental risk management process based on the guiding principles and the OECD guidelines is now being followed by a number of other Central and Latin American companies. And it is a recognition that the problem isn't just for the investor, it isn't just for the people who are affected, it's for the financial well-being of the country itself.
Does anyone else want to come in on any of those points that we've just raised? David?
I think it's actually useful to think about this quite holistically, because a lot of the time when people think about social unrest or conflict or whatever it is, you know, the focus is definitely on developing countries. Just shining a light on some of the risks that you see in developed countries. Brexit was catastrophic to a number of businesses, right? There were people that literally had to rethink their whole strategy for the next 20 years based on a referendum. So uncertainty is something that is global. And that's something that shouldn't be overlooked, because ultimately when people look at developing countries, Africa, Latin America, you know, the Middle East, Asia, there is a perception that, you know, it's all smoke and mirrors, and risk is thick in the air. And sometimes that is the case, but in a lot of these situations, that is not the case. And it is really about understanding the situation that you're stepping into. Obviously, since Brexit and you know the relevant I guess social changes that have happened in the UK, there have had to be adaptations here. And similarly, in all of the jurisdictions that people talk about for investment, you must understand what you're going into and what the adaptations are. What are the mitigations for the risk that you're looking at? So I just wanted to make that point, because oftentimes we look at social cost and we pin that on non-OECD countries, and we say there is this that may happen, this might go down the pan, and you know, you're investing here, but it's all dependent on electoral cycles, and when the new government comes in, it's all going to go to pot, and you know, they're warring factions in this area, etc., etc. That is not something that is unknown to the developed world. And the same way that we look at the risk in the developed world and say, right, that is a risk, I'm able to quantify it, I'm able to make a decision on how my business is going to go forward. That is the same approach that you should take in developing countries, with the right information, with the right risk mitigation tools, and with the right advice.
Mm-hmm. Dominic, I see you've got your hand up and bring you in.
Thanks, Sarah. And I think what everyone has been saying, John, Andrew, and David as well, I think the other thing people tend to forget, as David was saying, they seem to think that risk and corruption and the like is thick in the air in Africa and elsewhere. What people forget is that the younger entrepreneurs, and when I say younger, I don't just mean those in their teens and 20s, but those in their 30s and 40s. These days, they all have smartphones. They all have access to social media. They see what's going on in the world. And the people that we deal with want an effective rule of law in place. They get it. They've seen what's happened before. They've seen how people have made money the wrong way, the corrupt way, the illegal way. We'll just look at South Africa, not a developing economy, one of the most industrialized nations, well, probably the most industrialized nation in Africa. But see how state capture has torn that place apart with the older generation, and the younger generation now coming through and demanding that things are done differently. Things are done with the rule of law. And I think for me, that gives me hope that because of social media and the like, we are seeing an equality starting to come into place here, and those demands coming from the younger generation.
Faisal, I see you've also wanted to add something.
Yeah, thank you. I wanted to touch upon a point I think Dominic, Andrew, and David made, which is, you know, this idea that, you know, the perception of risk, and it's true that the perception of risk in working in emerging markets, you know, tends to people shy away because of that perception. But there are definitely ways to address the risk. You know, and for example, for us, I mean, we do it all the time. And one of the, I think, the things that was mentioned earlier is this idea of, you know, you want to work with a company in a place like this, that is that is least risky as possible. But at the same time, there's this expectation that they're going to have best in class, compliance or other, risk mitigation programs, which is not the case. I mean, if that was the case, they probably wouldn't need us, and they probably wouldn't need, other investors. But the way I think to handle that type of risk is much like the way that we handle commercial risk, right? Like if you look at non-recourse project finance, there's a lot of commercial risk until you build the project and it starts producing revenue. And with things like integrity risk, it can be, you can handle the risk similarly, where, if you're working with a particular project, you're working with a particular company, and you've done your due diligence and you determine, okay, well, the corruption controls aren't, where I'd like them to be, or the anti-money laundering controls aren't, that you can work with those entities and develop an action plan, where you are, where you've analyzed the gaps and you're helping your business partner meet those standards over a period of time. It doesn't have to be, today and before you invest, but you can say, okay, here's an action plan. We want you to do A, B, and C. And we're going to peg that to conditions of disbursement. So, by the first disbursement date, you need A. By the second, you need B. And in that way, bring up the standards of the business partner you're working with. And it's also very much true, again, both what Andrew Dominic was saying is that when you do that sort of just on the pure commercial basis, you are really raising the profile of the company. I mean, we see it all the time, where if we're working with a company and we're trying to improve them both from a compliance perspective, ESG, that other investors that we work with will be interested and may want to mobilize their funds to join in the investment. So, it's certainly it's key. It's in fact I would say one of our strategies in terms of the way that we work.
I mean, have you ever had a situation, Faisal, where it has gone wrong? It sounds like there's a huge amount of work that's being done in order to determine risk and to put in place, the right conditions that enable you to make the investment. And I mean, obviously, one hopes that the occasions when that goes south are very, very limited. But has it happened?
Oh, without a doubt. Because at the end of the day, on the front end, it's all about judgment, right? You all these tools, due diligence, are to inform the best judgment that you can make going in. When it doesn't work out, we have two main tools that we use. One are our commercial remedies, which we have exercised, and then the other is at the World Bank Group. We have a sanctions and debarment process that we use. In order to ensure that at least our entities are not doing business with those that have engaged in some of this misconduct in our projects. But on the commercial end, we've had a couple cases in the last few years. You mentioned one that came out of my bio, the Abraj Group, which was the largest private equity fund in emerging markets, and we, along with some other investors, had discovered through forensic audits some concerns, let's say, about one of the funds, which ultimately got reported in the press and quickly unraveled. I mean, 6 months later, the fund declared bankruptcy in Cayman Islands, and we spent a tremendous amount of time trying to find replacement fund managers for the number of funds that we were invested in. So it does happen, but I think you need to have the right tools in place. So for example, for us, we have very standard clauses that we use. And of course, there are times where you have the bespoke covenants and reps to deal with the specific situation. So for example, you're investing in a business where one of the senior management members has been accused of something, but you still have to wait for the outcome of that, or you have to wait to see how the organization is going to deal with that Are they going to suspend the individual? Are they going to, do they think that that the allegations don't have any merit? And in those type of situations, we will put in certain requirements in our finance agreements that that deal with the way that we want to handle that. So, for example, if we say that, oh, well, maybe if the person's actually indicted, then they have to be removed. Otherwise, it's going to be a default or a mandatory prepayment or something like that. So, we do it both on a template and a bespoke basis, but we're not also afraid to take legal action when we need to.
Thank you, Faisal. I see, Andrew, you've got your hand up.
I'd like to make two quick points, if I would. Firstly, building on what Faisal has said, we've talked a lot about risks that managers have to look at, but what about risks that financiers now have if they don't have an ethical due diligence on the application of capital? Faisal has spoken about the way that a multilateral bank does their due diligence, but what if you're a pension fund? What if you're a superannuation fund? What if you're a private investment house and you're investing in opportunities like Volkswagen and they have the ethical screw up like the diesel scandal? Is it possible that you could be sued for a lack of ethical due diligence on the application of capital? Now, the law firm I chair in the UK, Griffin Law, we're looking at exactly that question now, the vulnerability of the providers of capital not doing an ethical due diligence and then making them liable to be sued by their shareholders. The second point I'd like to make is in all of the discussion we've been having so far, we've talked about the rule of law and the ethical considerations within the constraints largely of the European Western common law view of ethics and law. I view the time in history we're going through right now as what I call the sixth great human transition. The five before this, Egyptian to Greek, Greek to Roman, Roman to Zoroastrian, Zoroastrian to Muslim, Muslim to Christian. Now we're going Christian to Chinese. I'm not saying this is good or bad. I'm not putting a value judgment. I'm saying it's happening. We are transitioning where the normal global dominance of trade, law, and military for the last few hundred years has been based out of Europe. It used to be in Asia, and it's going back to Asia. So whose rule and whose law is going to dominate over the next 20, 30, 40, 50 years? Again, I'm not criticizing. I'm making a point that we're in a process of change. And are people ready for that change?
John.
Yeah, I'd like to address a couple of points on financial institutions. The UN Office of the High Commissioner on Human Rights issued in August basically an opinion letter saying that banks who acted as nominee shareholders for anonymous investors had a responsibility as business enterprises under the UN Guiding Principles for conducting human rights due diligence to determine the risks as best they can of the ultimate investments that are being made, and I think that is, of course, the guiding principles. It's not legally binding, however, to the extent that financial institutions become involved in activities that are subject to the existing and upcoming EU mandatory due diligence legislation, I think that there may be legal consequences as well. The second point I'd want to make is on the rule of law itself. And I think that David mentioned earlier the protections that are afforded by bilateral investment treaties to investors, and that is true. The issue from a human rights standpoint is what happens when a state perceives a human rights problem that didn't exist before or needs to enact legislation to address an issue that has not been fully regulated. That can be perceived by an investor as a violation of the bilateral investment treaty, and which would then give rise to a claim before international arbitration tribunal known as ICSID, operated under the World Bank. And of course, investors are entitled to protect their investment and have their expectations met. At the same time, states have a duty to protect human rights and to protect the environment. This came up during the UN mandate when an Italian investor challenged South Africa's use of the Black Empowerment Act, and when the investor used a company in South Africa that was not, I think it was a subsidiary that was not was not sufficiently owned or employed enough people who were Black. And that's a real problem. You're starting to see that now as there have been bilateral investment treaty arbitration claims filed against states, including the United States, with respect to climate change regulations designed to address problems that had not been fully appreciated. All of that boils down to the initial contract on which, for which the investment is based on, and Professor Ruggie issued a report as a supplement to the guiding principles on responsible contracting for foreign investment and host states negotiations to make sure that the underlying contract, which you're seeking to enforce, is compatible with international standards, international human rights law standards. And that is something that is now being looked at even more closely as new bilateral investment treaty claims are being filed.
Thank you, John. I saw a moment ago David had his hand up, but either way, it would be interesting to hear from David about your perspective on this. And I know when we've spoken previously, you've spoken about some of the macro trends affecting the continent in Africa, and particularly environmental issues, effect of Paris. Wondered if there's anything you'd like to add in that regard.
Yeah, I think what's quite interesting is we're going into a very interesting time right now. I think if you look at investment generally in Africa and in emerging markets, they've typically been resource-based. So they've been based on extractives, whether it's energy, oil and gas, mining, et cetera, et cetera. And where we are now is that I think, especially with the Paris Agreement, we'll see what comes out of COP26. There are future developments that are going to come into play with the new Basel IV regulations. All of them are pushing ESG. And they're pushing us into a space where we are all having to consider climate change a lot more carefully. We're having to consider it in a way that actually affects bottom line in corporations. And I think this is shifting not only the perceptions of people from an ESG perspective, but it's shifting their investment decisions. And if you look at the punitive nature, and specifically looking at financial institutions, which is why I had my hand up, financial institutions are going to be penalized for lending into companies that have a bigger fossil fuel footprint than the Paris Agreement allows for. And that sort of action, which is very activist from a government perspective, from a legal perspective, actually shifts commercial decisions in a way that I'm not quite sure people have begun to appreciate yet. And the reason I say this is because the Paris Agreement was made, obviously in Paris. There's a lot of countries that participated that have decided themselves what their goals will be over the next few years to 2050. However, the repercussions of those decisions are huge. And when I look at, for example, the African continent, I looked at countries like Nigeria or Angola, Mozambique now, whose economies are completely leveraged towards oil and gas. Telling them that all of a sudden the investment world is going to start shunning investments in those sectors is detrimental to their entire economy, their way of life, even their plans to industrialize over the next 30 years. And when you look at population growth, and you look at the fact that Africa's population will continue to burgeon, and that by 2050, one in every two children born will be born on the African continent, there is an obvious need to industrialize. There's an obvious need to industrialize. And taking away the ability to invest in resource-dependent nations because of ESG principles and because of the Paris Agreement will actually have a detrimental effect on the ability to industrialize in a lot of ways. So I think there are some schools of thought that say we actually need to go and reinvestigate what we're trying to do here. And then there are others that say, no, climate change is real. This is happening. It is something that must be addressed. But how do we do it responsibly? How do we do it equitably and in a way that actually allows the countries that are most affected to be able to transition in a way that's responsible and sustainable and allows them to industrialize and actually serve the peoples that inhabit them. So I think that there's a lot of key issues that I think we need to focus on. And ultimately, the rule of law underpins a lot of it, because what the law says is what will drive both economic and perception, both economic decisions and perception decisions. But that doesn't detract from the fact that these key macroeconomic issues are going to shape the next few decades. And it's something that I think ultimately, I'm sure everyone on this call will agree, you have to focus on in order to be able to understand really the investment criteria that will drive decisions going forward.
Thank you, David. That's a huge issue and one we could probably dedicate a separate webinar entirely to, which I would certainly welcome. I mean, I can see, Andrew, you've got your hand up. I'm conscious of time. It's 14:08 according to my clock. So, Andrew, if you can let us know your thoughts briefly, then I was going to ask everyone very quickly what they see as the biggest challenge. I think, David, you may have just given yours. So unless you've got another one, then hand over to Mark for the last couple of minutes to just provide a bit of a summary on these points and talk about Redline Consultancy. But Andrew, I'll just give the floor to you for a second.
Yeah, I think David's just hit on such an important issue. When we talk about climate change, one of the things that people haven't factored in or really understood is one of the greatest impacts on future climate change is going to be poverty alleviation. Because when we talk about bringing our carbon emissions back to the year 2000 levels, we don't mean my carbon emissions. We mean the entire middle class. And as we double the number of people coming into the middle class, which is a good thing, more education, more health, more water, these people want cars, they want refrigerators, they want microwave ovens, they want all the stuff that we've got. And what we haven't actually twigged to is bringing the world's carbon emissions back to the year 2000 levels is going to be halving the per person emissions in the middle class. We've got to halve our emissions. And it's such a bizarre contradiction. Of course, we want poverty alleviation, but it's going to be the single largest driving factor for climate change.
I think
and what David said, just to bring it back to the theme of
you've stated the biggest challenge. I think that's possibly, quite terrifying to think through the implications of that. But if I could just go to everyone else before handing back to Mark. John, your thoughts, biggest challenge in 1 minute.
In 1 minute, populism, authoritarianism, fascism, terrorism, all of the ugly isms that have arisen over the past because we haven't quite got, as a global society, the relationship between business and society right. That, I think, is the biggest challenge that we're seeing today. But on a more granular level, will companies do more than just pay lip service to human rights due diligence and use it as a vehicle for actually improving their performance, or just as an insurance policy against liability? ESG. A third is ESG. How do you make every law firm and consultancy is rushing to advise on ESG. Well, how do you make sure that isn't greenwash? Are those consultancies and law firms doing their own due diligence on the human rights impacts of their services? I think those are three challenges.
Thank you, John. Dominic, I'll come to you next.
I had some thoughts, and then Andrew and David and John have totally blown those out of the water with their brilliant comments that they've made. Thank you, guys. The one thing I would probably say in emerging markets is something that has arisen for probably the last 20 years or so. And that is probably comes down to many ways to bilateral investment treaties, but actually just the interaction between nations. Because along with poverty alleviation, the biggest thing that I see, particularly in those markets, those emerging markets that are perhaps affected by deserts and the like, and they've been talking about for a long time, is scarcity of water and future conflicts that will come out of that over what they call the water wars. We're already starting to see that blow up there, but that's going to be affecting the emerging markets long before it affects perhaps what we can term the West or the developed markets here.
Yeah, thank you, Dominic. And Faisal?
2 words, digital divide.
Yeah,
I think to address a lot of these issues, and ESG is absolutely spot on. I think that we really need to address the digital divide.
well, thank you all. You've been absolutely fascinating. I wish we had longer, but it's been a really rich and certainly for me, very educational discussion. So I'd hand to Mark now for the last couple of moments just to really touch on those points and beyond. Thank you, Mark.
Thank you, Sarah. I just wanted to say why RLConsulting decided to host a webinar of this nature. RLConsulting is comprised of a number of individuals led by Dame Linda Dobbs, all of whom have a wide experience and different ways of working in the rule of law and upholding it. And secondly, this was a topic which we felt had not been discussed at any great length of late. And so we thought it was absolutely right that we do so. And one of the themes which has come across today is that foreign investment and rule of law are not a contradiction in terms, but they go very much hand in hand. And another dominant theme of today's discussion has been 2 issues, that of risk and also due diligence. And so these are areas in which RLConsulting can come in. Across our members, we have a wealth of experience to assist, particularly with those dominant themes of risk analysis, due diligence, whether in the more traditional form or in human rights diligence, but also in the range of legal skills. And here we work closely with our barrister colleagues in Red Lion Chambers, representational skills, be that diplomatic or presentational, security advice, assessing and analyzing the integrity of judicial systems. And that's very much ties in with what Andrew was saying about the enforceability of contracts under domestic law. And there needs to be an independent judiciary to ensure that parties have a fair trial and a fair hearing. Conflict and dispute resolution and investigations, these are all areas in which RLConsulting can assist. Dominic said that one of the things he said with reference to one country, but I think it's relevant to just about everywhere, is that people want the rule of law. Well, that's a commitment which RLConsulting shares and is available to assist in upholding and promoting the rule of law.
Thank you, Mark. Perhaps that neatly brings us around to which rule of law we'll end up with, as per Andrew's comments earlier. But I think it's perfect timing now. It's 2:15. Thank you all very much for your time, and thank you to our listeners and to those who listen in the recorded version. But we can sign off now. Thank you very much.